All right. So basically, today we are going to look at two standards. The IS-20, which is accounting for government grants and disclosure of government assistance. And we also look at intangibles, which is IS-38. All right. Why should we account for government grants? Mostly what most of the government or most of the governors of country, what they do is that before they want, because they want to encourage people to be in business, to invest in business, what they do is that whenever you are going to buy something and they think that this will be of a benefit to the country, they will try to assist you. They will try to give you a financial support so that you can be able to buy that. It's a form of motivation to businesses or companies. So that is mostly some of the things that the government of certain countries do. I don't know Ghana we have, but we'll talk about that one later. So what the government will do is that if they are aware that a country or a company is going to invest on something that is going to benefit the country as a whole or the nation as a whole, they will try to give them a financial assistance. They will try to give them financial assistance. So if the financial assistance is given, how do we account for? You see, for you to know how you account for government grants, you first have to understand the difference between grants and donation. You first have to understand the difference between grants and donation. You first have to understand the difference between grants and donation. So without wasting much time, what is the difference between grants and donation? Yakubu, Esther, what is the difference between grant and donation? Is there any difference? Is there any difference between grant and donation? Yeah. Someone's hand is up. What is that?
It was a mistake, but let me say something.
Okay.
For grants, I know there is a certain condition that has to be satisfied or be met before the grant is given. But with the donation, there is nothing to be done. The person is doing it or it is given because they are giving. But with grant, the government is giving, or if it's a company, the company is asked to employ, the government can ask a company to employ like 50 people in its company. So if they are able to do that, then if it is any asset that they want, the asset will be granted to them. Or if it is any monetary help that they want, it will be given to them. But with the donation, they are not supposed to satisfy any condition. It is just given to them.
Okay. That is very nice. That is very nice. Any other suggestion before we move on? Any other answer? Difference between grant and donation? All right. So if basically they say grant is a potential liability, something that is given on a condition. Is given on a condition that we are giving you this money to do this. It means that if you're not able to do what they're asking you to do, you might be paying the grant back. You might be paying the grant back. So a grant is a potential liability which might be paid back. But for the donation, we are just giving the money to you. Whatever you want to do with the money, just use it for whatever you want to use it for. For the donation, no condition is attached. For grants, they are saying that you should employ, US is giving grant to Ghana. They are saying that you should employ 70% of the graduate, the fresh graduate. If Ghana is not able to do that, the people will come for their grants because the grant was given for a condition. But for donation, we just give you the money. Whatever you want to use the money for is none of our business. What you have to know is that IS-20 is not covered by donation. IS-20 is not covered by donation. So whenever there is a donation, the management of the company has a discretion to decide whether the donation to be accounted for as a grant or it should be accounted for as a normal donation. So IS-20 is not covered by donation. IS-20 is covered by grants, a potential liability. Why should we account for grants? Grant is a potential liability, and this might be given for a number of years. So if you are giving this for a number of years, or we are saying that take this amount of money and employ fresh graduate for 5 years, you can't just go and write all the total amount to your statement of profit or loss for a year. No, you have to amortize this amount over the period given to you, the 5 years. Sometimes the grant can also be given relating to an asset. If that happens, the asset will be having a useful life which may be more than 5 years or 10 years. So the grant must also be realized over the useful life of the asset. That is one of the reasons why we should have a standard for grants. But before we move on, you have to know that the IS-20 covers government grants and government assistance. So what then is a government grant and what then is a government assistance? If you are talking about government grants, we are talking about government giving assistance in a form of transferring of financial resources. They are going to give you money. They are going to give you money. But if you are talking about government assistance, although the government is giving you a help, but this help is not in monetary terms. They are not going to give you any money. If the government is giving you a tax rebate that pay your tax rate is 25%, but pay only 15%, the government is not removing money and giving it to you. Although the tax is going to reduce, although your money that you're going to pay to them is going to reduce, but they are not giving you money. So anything that the government is giving to you, not in form of monetary value or not in form of transferring of resources, that is seen as a government assistance. And we don't account for government assistance. We only give disclosure for the government assistance because there is no economic value. It is not involving any monetary value. There is no amount. What double entry are we going to pass? We are not receiving any money. And what are you going to record? So for government assistance, it doesn't involve transfer of economic resources or monetary resources or anything. So we give only assistance to, we give only disclosure to government assistance. But government grants, it involves government giving you resources, a transfer of resources, a transfer of resources, a transfer of resources. And this government grant can be given for 2 items. Government grants can be given for 2 items. It can be given in terms of revenue, maybe to reduce your payroll. They are saying that, okay, since you are employing most of the fresh graduates, take this money to pay part of your salary. That is given for day-to-day operations. We say that is an example of you reducing your payroll, reducing your payroll expenses. That is a revenue grant. So if the grant is given in relation to day-to-day operations, to settle day-to-day operations or part of your day-to-day operations, we say that is a revenue grant. But when the grant is given as a result of you trying to acquire a capital asset, you want to buy machinery and the government is giving you a grant. This particular machinery that you are going to buy is an investment in capital assets. So if you are given a grant towards the acquisition of the machinery, that is seen as capital grants. So we have 2 types of grants. First one is we have revenue grant, which is given to reduce your payroll expenses, day-to-day operations. And we also have the capital grants, which is given towards acquisition of long-term. If you are given a grant, this is if they join, they will not mute themselves. So. All right, let's move on. All right, so assuming the government is just saying that, okay, anyone who employs 20,000 employees in a year, 20,000 employees in a year, is the turn off your video for everyone, or just mention the person's name, the person will read? I'm trying to turn the video off for the person, but I'm finding it difficult. Maybe the network is worrying the person or something. Okay. So assuming the government is saying that whoever employs 20,000 of the citizen in a year, the government is going to give the person 200,000 Ghana cedis. And you people, your company has employed more than 20,000, and you are saying that since the government made this announcement, you are going to recognize a government grant of 200,000 Ghana cedis. As an accountant, what are you doing? Let me look for those who are accountants at this place. Olivia, are you there? Olivia, are you there? Senior Socrates, are you there? Okay. Where is my people? Habakkuk.
Yes, boss.
Okay, answer this question. Although you are not accountant, but answer. You're an accountant of a company, and the government has made an announcement that any company that employs more than 20,000 employees in a year will be given 200,000, and your company has employed more than 20,000 employees. As an accountant, will you go ahead and be saying that you are recording a government grant of 200,000? Will you do that?
I think if the money is being given,
If the money is what?
you should report. Being given to you, you should report it.
If the money is given, you record. But this case, you haven't received anything.
No. I think there's nothing to report.
You're not going to record anything, isn't it? All right. Let's look at the conditions that you have to see before you recognize government grants. The conditions that you have to meet before you recognize government grants. So this one, the 200,000 over here, what is the assurance that you are going to receive the money? There is nothing to show that the money will actually be. Who is that person who is talking? Gideon, please. Just the video. Okay, I've done that for you. Okay. The 200,000 over here, there is no assurance that the company is going to receive the money. There is no assurance that the company is going to receive the money. So you can't go ahead and recognize a government grant of 200,000 unless there is enough evidence that you are actually going to receive the money. But if there is no evidence, you can't recognize a government grant of this. So before you can recognize a government grant, you need to look at two conditions. So entities should not recognize government grants until it has a reasonable assurance that the entity will comply with any conditions attached to the grants. You have to know that grants will come with conditions. Grants will come with conditions. So before you can say you are going to receive the grant and put it in your books, are you sure that you are going to comply with all the conditions attached to the grants? You are going for a grant and they are saying that if you should take the grant, you have to make sure that 200 of your employees are being laid off. That would be a very difficult thing for you. If your 200 of employees are laid off, what are you going to get them to help your business keep running? That would be very difficult for you. So looking at the condition, maybe you cannot be able to do it. So you can't recognize the grant because you can't comply with the conditions attached to the grant. The next one is that the entity will actually receive the grants. So that is the place that we have the 20,000. The government is saying that anyone who employs more than 20,000 employees, they are going to give the person 200,000. How sure are you that you are going to receive the grants? If you are very sure, everything is showing that you are going to receive the grant. Past experience is showing that, okay, whenever this grant happens, the entity end up receiving the grant. With this particular information, the accountant can go ahead and recognize the grants. I'm saying that IS-20 does not cover donations, but we are going to talk about when a donation is made. How should we account for that? We are going to talk about that. Whenever this IS-20 covers only government grants. What if the owners of the company, the shareholders of a company, what if the shareholders of a company has given amount towards acquisition of assets, or they have given amount to the entity that they should use it to pay their employees? What if the owners of the company has given 200,000 to the entity to pay their employees? How are you going to account for this particular transaction? It's not easy. How are you going to account for this? Okay.
To be taken as
Esther, to be treated as what?
as a donation.
As what? It will be treated as a donation from what?
From the shareholders of the company.
Okay. So it will be treated as a donation from the shareholders of the company. That is very nice. That is very nice. I can also tell you that this is a form of a new contribution by the owners. So they are introducing a new capital through through paying of the employees' expenses. So I can also decide to go and capitalize this, add it to their equity, because it's a new capital they are introduced to the company. So in this case, I will go, instead of treating it as a donation, I will go and add it to their what? Their already existing capital that they have, because this is a form of introducing a new capital through paying the employees' expense. But you can also do that as a donation if they are not going to take the money back. Are you okay? All right. That is very nice. Let's look at types of government grants. I'm saying that government grants may be classified as capital grants, those grants which are made to contribute towards acquisition of an asset, and revenue grants, those grants which are made for other purposes, such as payment of wages. Let's take them one by one. Let's look at grants relating to assets. Capital grants are grants relating to the construction, purchase, or ownership of capital assets by an entity, where grants are received in relation to a depreciating asset. The grant will be recognized over the period in which the asset is depreciated in the same proportion. What we are saying is that we are going to buy plants. We are going to buy plants. And the cost of the plant is 1 million. And the government has given us a grant of what? 200,000. In actual sense, how much are we spending on buying the plants? How much are we spending? How much is the company spending on the acquisition of the plants? In actual sense, how much are we spending?
800,000.
Is it
We are
800?
spending 800,000 in what? In actual sense, it's 800,000 that we are what? We are spending. So that the net amount that we are spending is 800,000. If this plant will last for 10 years, then we can depreciate the 800,000 over the 10 years. This is in actual sense. We are spending what? The plant is 1 million, but the government is paying 200,000 out of that. It means that we are buying the asset for only what? 800,000. So we can take the 800,000 and depreciate it over the remaining useful life. We can also say that since the grant is given in relation to the plant, which will last for what? 10 years. Grant is an income. We can decide the grant is given in relation to plants. So what we do is that the plant will last for 10 years. We can also amortize the grant over the useful life of the plant, where we will still assume that we are paying the 1 million and we are receiving a grant of 200,000, and the grant will now be amortized over the remaining or over the useful life of the plant. So in this case, we depreciate the asset using the useful life of 10 years, and we also amortize the grant. The grant is 200,000. So every year we take 20,000 to statement of profit or loss as an income, and we take 100,000 as depreciation to the statement of profit or loss. So if you count to capital grant, we account for the capital grant in two ways. The first one is we have what we call netting of the grant against the cost. Netting of the grant against the cost, or reducing the cost of the asset with the grant. So in this case, the value of the asset is, the plant is 1 million, and government is giving us a grant of what? 200,000. So how much are we spending? It's 800,000. This is what we call reducing the cost with the grants, netting off method. But if you come to treating the grant as a deferred income, we keep the plants at its original value, and we also take the grant. But what we do is that we amortize the grants over the useful life of the assets. So we depreciate the asset based on the cost, and we also amortize the grant over the useful life of the assets. So we show depreciation, and we still show what? Grant income in the statement of profit or loss. So we take the grants over the useful life of the asset. Assuming we are using net method for this particular one, which is the first one, 1 million minus 200,000. What are we going to have? Our depreciation will be 80,000 every year, isn't it? Okay. If you're using 1 million, which is the deferred income, our depreciation for each year will be 100,000, and the amortization of the grant will be 20,000. Grant is an income. So you can see that if we subtract the income from the expense, our net will still be 80,000. This is the net depreciation. So we have two ways of doing it. Either you reduce the cost of the asset with the grants by subtracting the grant from the total cost of the asset. Then you now use the net figure, you depreciate the net figure over the useful life of the asset. Or you treat the grant as a separate income and also carry the asset at its original cost. Then you depreciate the asset at its original cost, and you also amortize the grant over the remaining useful life of the asset, because the grant was given in respect of that particular asset. That is how we do the capital grants. That is how we account for the capital grants. But before this, let me ask this question. Assuming government has given you an asset, which is 20,000 as a grant, how are you going to account for this? Which of the method that you are going to use? The government has given you an asset as a grant. Now, since you are venturing into this one, we are giving you this particular plan to do this and this, to do this and this. That is the condition. And they are giving you plans. They haven't given you money. How are you going to account for this? And which of this method are you going to use?
I think the one that you will be amortizing the total distance over the useful life, and then you will be sending it to P&L as income.
Okay, that is the second one, isn't it?
Yes, please.
Why do you think it should be that one?
Because in natural sense, the organization or the company hasn't contributed anything.
Okay.
Any cost to the acquisition of the plant.
Okay. So that is why you think it should be done that way, isn't it?
Yes, please.
All right. All right. That is very nice. Any suggestion before I move on? Any other person? Which of the methods should we use? Reducing?
What's the question again, please?
The what?
The question.
The question again. Who is that?
I didn't get the question.
That was the last question that I have. So
This Yakubu.
the question is finished. Okay. I'm saying that.
I didn't get it.
Okay. I'm saying that the government has given you a plan as a grant. You want to venture into maybe a certain activity, and the government is saying that since you want to go into this activity, it will help the country. So because of that, we are giving you this plan to do this and this. It means that if you're not able to do what they are saying, you are going to return the plan back to them. And I'm saying that for this part, this is a government grant. How are you going to account for it? And this is capital grants. How are you going to account for it? Are you going to use the reducing the cost of the asset with the grant, or you use deferred income method? That's what I'm saying. Yeah, Joyce. Yeah, Joyce. Joyce, your hand is up.
Hello, can you hear me?
Yeah, I can hear you.
Yes, can you hear me?
I can hear you.
Okay, so that in this case, I don't think that there will be depreciation. So when you amortize it for a useful life, you just recognize it in
I can hear you. Joyce, I can hear you.
Hello?
Yeah, I can hear you. Oh, shit.
Yeah, I think my network is bad.
The network is bad. Can you type what you want to see so that I can read? All right. So, Senior Socrates, what you said is the best way to go about this, because if you're using reducing balance method, what will happen is that you haven't paid any amount for the grant, isn't it? You haven't paid any amount towards acquisition of the plants. So if you're using reducing balance method, it means that it will be 200,000 minus 200,000, isn't it?
Yes.
And at the end of the day, you are having a plant of zero, but you are not having any plants in the statement of financial position, but you are using the plants. How come? It doesn't make sense. So if you are using the reducing the cost of the asset with the grant, it means that we are not going to have any assets or any plants in the statement of financial position, because we didn't pay any amount. The cost of the asset is the same as the grant that we have received from the government. So if we net it off, we are having zero. Meanwhile, we'll still be using the plant in our operations. It doesn't make sense. So the best way to go about this is to use the deferred income, because the cost of the asset is the same as the grant. So you are not going to incur any additional cost because the depreciation is the same as the amortization of the grant. That is you use a deferred income method. You use a deferred income method. You use a deferred income method. Assuming the entity wants to buy an asset which is 250,000, and the government has made a donation towards the acquisition of 50,000. And the asset will last for 10 years. The asset will last for 10 years. How are you going to account for this? It's donation, not grants. It's donation, not grants. How would the entity account for this? We are 24 here. How would the entity account for that? The entity want to buy a plant 250,000, and government made a donation of 50,000 towards acquisition. The plant has a useful life of 10 years. How are you going to account for this?
Yeah, can you hear me?
Is it?
Can you hear me?
Yes, I can hear you somehow now.
I'm saying that I think you let and then you amortize the cost and charge depreciation over the useful life of the assets.
Okay. That is based on your understanding, isn't it? Okay.
Yes, please.
Okay. But you have to know that IS-20 is not covered by donation, isn't it? All right.
Yes.
Okay. All right. That is very nice. But you have to tell me why you should do that. Why are you doing that?
Because if the donation to reduce the cost that you are going to incur to buy the plants, then you are going to use 20,000 to purchase the plants because you receive 50,000.
Okay.
And that's what I think.
Okay. That is what I'm also thinking I should do. But I have a reason. Okay. Senior Socrates. I saw you that you're this thing. Okay. How do you think we should account for 50,000 donation? It is not easy.
Hello.
Just add it
Yeah.
back to your
Yeah, I can hear you. Senior Socrates, I can hear you.
Yeah, as Joyce said, you less the 50,000 from the 250,000, and you depreciate the 200,000 over 10 years.
Okay.
So that you take 20,000 to P&L. And the 50,000 donation, since you are saying, or the standard is saying we don't consider donations as part of government grants, it can be added to the owner's equity.
That is only if it is the owners that are giving the donation. This one is a government. It's government that is giving the donation. Yeah. Okay.
Then, okay.
You just add it to the revenue.
I heard someone is saying that you should just treat it as a revenue item that we go and take it to the year that we receive the donation, isn't it? That is also correct.
Okay.
But the question is, this donation was given towards acquisition of what? Plants. So if you are recognizing only all the 50,000 as a revenue item for that particular year, this does not give a faithful representation of the donation, because the donation was given towards a plan which will last for 10 years. So to give a faithful representation of the financial statement, it is advisable for you to either amortize the donation over the useful life of the asset, or you net it against the cost of the asset. That will give a much information or detailed information about the treatment of the donation. Although you can go and subtract it or treat it as a revenue for the year, but this donation is given in relation to a plan that will last for 10 years. So if you are recognizing that as a revenue for a year, it's correct, but it doesn't give a match or a faithful representation of the donation. It doesn't give a much detail about the treatment of donation. Some people, they might see it and they will question how that you have treated the donation. So it will be advisable for you to assume that the donation is a grant. You amortize it because it's given in relation to plants. So the plant is 10 years. You amortize the donation over 10 years, or you subtract it from the cost of the asset and now depreciate the net amount. But IS-20 does not cover government donation. It's relating to only government grants. But in the exam, the question will be on grants. But in practice, what if the government gave donation on this? You should be able to treat the information so that to give a faithful representation of the financial statement. All right, let's come to, yes, Joyce.
I'm a bit confused. Can
Okay.
maybe explain further? So are you saying that the donation, the right treatment is to amortize the donation that we are going to
I'm not saying that that is the right treatment, and I'm saying that to give a faithful representation of
over the useful life of the asset. Is that the right?
yes, I'm not saying that that is the right treatment. I'm saying that for you to faithfully represent your financial statement, to give a true and fair view about the treatment of the grant, it is advisable for you to what? Amortize the donation, because it is given on, it's given in relation to an asset that will last for 10 years. Joyce, can you hear me?
Thank you. Yes.
Okay, I'm not saying that is the right treatment. All right. Let's come to capital grants. Let's pick an example on capital grants. Let's pick an example on capital grants. Then okay, let me just pick the example that is solved there. How do we solve it? How we good one? Okay, let's look at this illustration. Let's look at the illustration 1. Who is reading for us? Auntie Eva, read for us.
Okay, please, I'm trying to find the question on my phone. Illustration 1.
After the presentation of grants relating to assets, ABC Limited received something.
Okay. So ABC Limited received 15,000 grant in respect of a plant costing 100,000 Ghana cedis. The company depreciates plants at 20% per annum on a line. Show the financial statement extract in respect of the grant for the year using both methods.
Okay. So let's look at the first method. Let's look at the reducing the cost. Reducing the cost of the asset, or the netting method. Let me just put it netting method. Okay. So the netting method is, we have the cost. What is the cost of the assets?
100,000.
100,000. What is the grant?
15,000.
So we subtract the grant from the cost. And what is the net amount that we are paying?
85,000.
85,000. So this is now the value of the plants. So what will happen? For the year we charge depreciation, isn't it?
Yes.
So we have depreciation of 85,000 divided by how many years?
5 years.
5 years. 20% is 5 years. It means that the asset will be used 5 times. If every year we are using 20%, the asset will be used 5 times and it is gone. So the depreciation is how much?
17,000.
17,000. So in the statement of profit or loss, we show depreciation of how much?
17,000.
17,000. But in the statement of financial position, we show plants. What will be the current value of the plants now? It will be 85,000 minus what?
17,000.
17,000. And that will give us how much?
68,000.
68,000. Okay, 68,000. That is the netting method. All right. Let's look at the deferred income method. Deferred income method is that grant will be treated as a separate item whilst we carry the assets at the normal value. So the cost of the asset will be 100,000, and the grant will also be 15,000.
Hello.
Yes, yeah.
Can you please explain the 5 years? Can you still use the 20%?
Yes, you can use 20 times 85. What are you getting?
It will be the same thing.
But what
Yeah, it's the
we are,
same 17,000.
what we are saying is that if every year you are using 20%, it means that you just if you use the asset for 100%, it means that the asset will be off. You are not going to use the asset again, isn't it? So every year you are using 20%. The next year it will be 40. The next year it will be 60. Next year it will be 80. The next year it will be 100, and the asset is exhausted. You will not have it again. So the question is, how many times can you use the asset for 20% and you will be 100% and the asset will be used up? That is a 5 times, which is a 5 years.
Okay.
So whenever you are giving the percentage, divide the percentage by 100. So 100 divided by the percentage given to you give you the this thing in years.
Okay.
All right. So let's come to deferred income. Deferred income, the asset will be carried out the old amount, which is 100,000, and the depreciation will be what? 100,000 divided by what? 5. The depreciation will be how much?
20,000.
20,000. Okay. Let's come to the grants. It means that we are going to 1 year has passed, so we are going to realize 1 year of the grant. So we amortize the grant also. So amortization of the grants. We amortize the grants also. So this will be 15,000 divided by 5. How much will be that?
3,000.
3,000. But the grant is what? It's an income, isn't it?
Okay.
So depreciation will be shown as an expense, while the grant will be shown as income. This is 3,000. You can see depreciation is an expense of what? 20,000. Grant is an income. If you net the two, how much are we getting?
17,000.
Which is the same as the figure that we sent to the net method. It's the same thing that you are going to get, but just that we are showing them separately. So we are going to have depreciation of 20,000. Then we also have the grant as an income. Grant as an income, which will be 3,000. Okay. So if you subtract the two, you see that you have a net expense of 17,000, which will always be the same as if you are using the netting method. Okay. Let's come to statement of financial position. We are going to show plant at what amount?
100,000 less 20,000.
Okay, and that will give us 80,000. Am I correct?
Yes.
So that will be under current assets. That will be under non-current asset. If you count non-current liability, we are going to show deferred income. How much will be the remaining grants?
12,000.
12,000, because it's 15,000. We have already realized 3,000 out of it. So it will be left with 12,000. This is how we account for the grants relating to capital assets under both method. Under the both method. Let's look at grants relating to income, which is revenue grants. These are grants other than those relating to asset. An entity satisfy condition and other than the construction or purchase of capital asset to qualify for such grant. Grants related to income are presented as part of profit or loss, either separately under a general heading, other income, or by reducing from related expenditure. So what they are saying is that if you are given a grant to pay employee salaries, wages of 20,000, and the grant is given to you, the grant given to you in relation to this is 5,000. What they are saying is that you can show the total wages as expense, and you can also show the grant as other income in the statement of profit or loss. Or you see that, okay, if I'm to pay the people 20,000 and government is giving me 5,000, it means that in effect, I'm paying only 15,000. So you net the grant against the expenditure. That is the second point that they are talking about. So if the grant is relating to income, or we call it a revenue grant, where they are saying that if you are able to employ this number of people, it's not towards acquisition of any capital asset or construction of any capital assets. It is for satisfying a condition. If you are able to do this, we give you this. Sometimes the entity may incur the expense in the past. Maybe in 2012, the entity has incurred expense, or they say that any entity that employs more than 2,000 employees will be given a grant. And the entity has employed these people in the past. And the government is now giving a grant in 2023 for any entity who has ever employed more than 2,000 employees. And the grant is now 10,000. Will you be waiting to meet the condition of you employing 2,000 employees before you recognize the grant, or you just recognize the grant because you have already satisfied this condition in the past? Will you be waiting to employ a number of employees that will be 2,000 again before you recognize the grant, or you go straight forward and recognize the 10,000 because you have done this in the past? What are you going to do? Senior Socrates, what are you going to do?
The question again.
I'm saying that the government has given a grant of 10,000 to any company who has ever employed 2,000 employees before. And in the past, your company has employed 2,000 employees in the past, and now they are giving the grant in 2023 that any company that has ever employed 2,000 employees before, they will be given a grant of 10,000. And I'm saying that, will you be waiting to employ a new employee which will be 2,000 before you recognize the grant, or you just recognize the 10,000 and then say that we have done this before?
Since the government is saying those who have done it before qualify for the grant, I think we will take it.
Yes, we just recognize the grant. So a grant given in respect of past events, something that the entity has done already. What you do is that you just go and recognize the grant in statement of profit or loss, because this grant was given in respect of past event, which you have already met the condition. So you don't have to meet additional condition before you recognize the grant. So any grant given in respect of what past events, which the entity has already rendered or has already met, the entity will just go ahead and recognize the grant. That is it. All right. And also, if there is no conditions attached to the grants, you go ahead and recognize the grant. In that case, you assume that the grant is what? It's a donation. There's no condition attached to the grant. They are not telling you that do this and do that. So you just go straight forward and go and recognize the grant as if the grant is a donation. Are we okay? All right. Let's look at illustrative question under revenue grants before we look at repayment of grants. Then we know that we are done with government grants. Auntie Eva, can you take that for us?
Please, the question.
Under the grants relating to income, revenue grants.
Okay, yeah. For the, I don't want to pronounce it wrong, so I'll say D Limited.
Okay.
D Limited is a large manufacturing company. Wherever possible, it structures its operations to take advantage of any financial assistance available from national and regional authorities. During the year, D decided to relocate some of its other operations to a regional development area, which offers attractive labor costs and tax incentives. The regional governments agreed to contribute 200,000 Ghana cedis as a result of these setting up in the regional development area. There are no particular conditions as to what the money should be spent on. The cash was received on 1st August 2019. Required. In accordance with IAS 20, Accounting for Government Grants and Disclosure of Government Assistance. Explain the financial reporting treatment of the above in the financial statement of D for the year ended 31st December 2019.
Okay, explain. So what should we do as the financial accountant of that particular company? What should we do with the 200,000?
D Limited should recognize it as a grant because they got the money because they cited their business at that development area.
Okay.
And also there are no conditions attached.
There are no conditions attached to what?
To the use of the money.
So you just recognize the money straightforward as a revenue item because there's no condition attached to the grant. So we don't even know whether we should hold the money and be waiting to satisfy the condition or something. But since there's no condition attached to the grant, we assume that the money given to us is a donation. Straightforward. Profit or loss, 200,000. Are we okay? All right. That is about revenue grants. Let's look at repayment of grants. Then we pick maybe 2 questions on grants. Then we are done. All right. Repayment of grants. We say that grants comes with a condition. It means that along the line, if the entity is not able to satisfy the condition, what we do is that they have to pay the money back. They might end up paying all, or they might pay parts. But we say that there are 2 types of grants, revenue grants and capital grants. Assuming that you are giving a grant of 20,000 to employ employees for 5 years. You are giving 20,000 to employ maybe 5,000 employees continuously for 5 years. Okay. And you have done 2 years already. What will be the remaining portion of the grants in your statement of financial position? This is for 5 years, and you have spent 2 years already. What will be the remaining portion of the grant in your statement of financial position? What will be the balance of the grants left?
12,000.
That will be 12,000, isn't it? All right. Assuming that the government is saying that in the 3rd year, you are not able to meet the condition. So pay 18,000. Pay 18,000. What will happen? Will you still be having 12,000?
No.
You go and cancel the 12,000 because you are repaying the grant, isn't it? Okay. You go and cancel the 12,000. But what will happen? Okay, let me come here. In actual sense, if you are giving 20,000, they are now saying that pay 18,000. In actual sense, how much of the grant was actually received?
2,000.
2,000, isn't it? Okay. But how much have you recognized over the 2 years?
8,000.
8,000. So what are you going to do? You have to go and reduce the what? 8,000 to 2,000, isn't it? All right. That's another way of doing that. You are going to pick 18,000 and you have 12,000 left. What will happen is that you go and cancel the 12,000 because the grant does not exist. But if you cancel the 12,000, what will be the excess?
6,000.
6,000. What was the grant received over the, what was the grant recognized in statement of profit or loss over the 2 years?
8,000.
8,000. So if you send the 6,000 as an expense, what will be the amount left?
2,000.
So the 2,000 represent the actual grants received. the actual grant received. So if you are repaying a revenue grant, go and ask yourself, is there any grant remaining on that particular account? Is there any grant relating to the revenue grant in the balance? If there is it, go and cancel it and take the excess to statement of profit or loss. So we are having 12,000 grants relating to that. What will happen is that this 12,000 does not exist, so we cancel it. If you cancel it, we are going to have 6,000 because we are paying 18,000. We cancel 12,000, it will be left with 6,000. What will happen? This 6,000, we have taken 8,000 to statement of profit or loss, but in actual sense, we should have taken 2,000. So let's go and reduce the 8,000 to 2,000. Then you take the remaining portion, which is 6,000, to statement of profit or loss. That is what we do about the revenue grants. Revenue grants. The information is revenue grants is not that difficult. The issue is the capital grants. Is the capital grants. Okay, Joyce.
And so if you are canceling the 12,000, what are you doing? Are you crediting your assets and debiting the P&L or the donation account?
This is revenue grants. It's not relating to any assets.
Okay.
Are you okay?
So meaning you debit your revenue account.
Yeah, so
yes, you debit the revenue account because the grant will be an income, which is having a credit account.
Okay.
So you debit your grant account, then you credit your what? Cash, because you are paying.
Okay.
But you are paying 18,000. Where would the 6,000 go? The 6,000 is the excess grant that you have recognized over the year. So you go ahead and debit your profit or loss and still credit your cash.
Okay.
Are we okay now?
Okay.
You like the double entry power?
That makes sense to understand the reason.
Okay. Me too. I've forgotten about double entry for some years now. Okay, so I'll be using a double entry, no worry. Let's come to capital assets. Capital assets. Capital assets, you can see that we use two methods, netting method and what?
The deferred income method.
The deferred income. Let's assume that the first question that we saw, where the assets, the plant was, Yeah, corporate reporting people, there won't be any evening class today because I realize that people, you are tired. So we do it tomorrow. All right.
Oh, okay. All right. That's good.
Okay. So the grant is what? 15,000. Okay. Assuming in the third year, we are not able to meet the condition again. So let's assume that we are using the netting method. The value will be 85,000, isn't it? Okay. Assuming in the third year, we are not able to meet the condition of the relating to the grant again. So the grant becomes repayable. The grant becomes what? Repayable. The grant becomes repayable. So we are repaying the grants in the third year. The useful life of the asset is 5 years. So we are using the netting method. Assuming in the second year, we are recognized the grant for 2 years already. Assuming in the third year, at the beginning of the third year, we are not able to comply with the conditions of the grant again, and the grant becomes what? Payable. If the grant becomes payable, how much are we paying? If the grant becomes payable, how much are we paying?
9,000.
No, the grant becomes repayable. It means that we are paying full. The grant becomes repayable. Yeah, the grant becomes repayable.
Okay.
The 15,000 that you have taken, you pay all. So we are paying all the 15,000. Are we okay?
Why?
No, it happens. If you're not able, you see, this is okay. If you're not able,
but an instance where you've already purchased the asset, the plant.
No, they are saying that if you purchase the asset, use it for this, and you're using the asset for different things. You see, grants, let me just put it like this. Grants is just like a loan given to you. So if you default it, it will go against you. So they are saying that, maybe they are saying that employ 50% of Ghanaians. Now you are having 70% of your workforce are foreigners. The government will say that you have defaulted the grant terms, so pay the money. You pay all the money. It means that they haven't given you that. The meaning is that the grant has not been given to you at all.
Oh, okay.
If the grant becomes repayable, the best way of you to. Oh, Isaac, I have all my notes in the listing. Don't worry, after the lesson, I will still send it to you. I will still send it to the page, but the notes are there. If someone can reshare them on the page, that will be fine. Okay. Whenever they say the grant becomes repayable, the best way to know how you can account for this is that the portion that you are paying, assume that that portion of the grant was not taken at all. If that portion of the grant was not taken at all, then what should have been the cost of the asset at the day that you purchased the asset? Then you now start depreciating the asset as if that part of the grant was not taken. Okay. So what will happen is that if the grant becomes repayable, it means that at the date of granting, at the date of purchasing this particular asset, the grant was not taken at all. Are we okay? If the grant was not taken at all, what should have been the depreciation? And what is the depreciation after you consider the grants? After you consider the grants, the depreciation for each year will be what? 17,000. Am I correct?
Yeah.
After you have considered the grant, the depreciation for each year will be what? 17,000. And you have used how many years already? 2 years already. So the total depreciation will be 34,000. Am I okay? All right. Right now the grant becomes repay. Yeah, Joyce. Joyce, is it a mistake? Your hand is out.
Sir, sorry to draw you. Yeah, sorry to draw you back in. So the revenue was it to
The what? Joyce, the network. Joyce, I can't hear you, Joyce. Network.
Yes, I'm saying that the revenue will cost me. Yeah.
Oh, I can't hear anything. Auntie Joyce. Okay. So if the grant is taken, we are using netting method. What will be the depreciation for each year? Depreciation will be 85,000 divided by 5. So each year, our annual depreciation will be 17,000. And we have done 2 years already. So our total depreciation for the 2 years will be 34,000. All right. But they are saying that in the third year, at the beginning of the third year, the company can no longer comply with the conditions attached to the grant. Therefore, the grant becomes repayable at the beginning of the third year. Okay, Joyce, the thing is, all the grants, the condition is the entity should be sure that they will comply with the conditions attached to the grants. The grant will actually be received. So if the revenue grant is given in relation to you employing employees, the workforce of your employees, or 50% of the workforce of your employees should be local or Ghanaians. That is the grant given to you for 5 years. 5 years. And you are not able to do that, then the grant will become repayable. But if they give the grant to you that, okay, we are giving this grant to you because you are able to employ 5,000 employees and you have recognized the grant, and the government has done audits and they realize that no, you are not able to employ 5,000 employees over the years, then you have deceived them, so you have to pay the money back to them. So anything that will make the entity not go according to the conditions attached to the grants will make the grant repayable. So if you default the conditions, the terms and conditions attached to the grant, they can take the grant back. You have deceived them that you have employed 2,000 employees. So they are giving you the grant and they have done audit. You are able to employ only 1,800 employees. It means that you have deceived them. So you are not qualified for the grant. So you have to pay the grant back. Are we okay? Joyce, are you okay now? All right. So assuming we are taking the grants, assuming we are taking the grants, our annual depreciation will be 17,000 and total depreciation for the 2 years will be 34,000. But they are saying that at the beginning of the 3rd year, the company was not able to comply with the terms and conditions or with the condition attached to the grant. So the grant becomes what? Repayable. If the grant becomes repayable, we are paying 15,000 in all. If we are paying 15,000 in all, it means that it was the entity who purchased or who paid all the 100,000 for the asset, isn't it? If we are paying 15,000, it means that the entity paid all the 100,000 for the asset. If the entity paid all the 100,000 for the asset, it means that the actual cost of the asset is 100,000, not 85,000. The grant was not taken at all. So if the grant was not taken at all, what would have been our actual depreciation at the end of every year? The actual depreciation will be the actual value, which is 100,000 divided by 5. How much are we getting as a depreciation?
20,000.
We are getting 20,000. Okay. Okay. At the end of year 2, what is the carrying value of the asset when the grant is taken? If we are taking the grants, what will be the carrying value of the asset at the beginning of year 3? It will be 85,000 minus 34,000. That is giving us how much?
51,000.
51,000.
Okay. That is if the grant is taken, isn't it? Now that we are paying the grant will not be taken. So what will be the carrying value of the asset at the beginning of year 3 if the grant is not taken?
60,000.
That would be what? 60,000.
60,000.
Okay. But what is the value of the asset if the grant is taken? What is the carrying value?
51,000.
So what we have to do to 51,000 to have 60,000? What do we have to do to add what do we have to do to make the
Add 9,000.
We add 9,000. Okay. The time that the grant was taken, what was our annual depreciation?
17,000.
17,000.
By the time that the grant was not taken, what should have been our annual depreciation?
20,000.
It means that we have overcharged the depreciation by 3,000 for 2 years, isn't it?
Okay.
Yes.
We have undercharged the depreciation by 3,000, not over. Undercharged the depreciation by 3,000 over what?
2 years.
2 years. So what are we going to do? We now send the overcharged depreciation because this is an estimate. So we send the 6,000 as we add the 6,000 to the new depreciation now and go and add it and go and send it to statement of profit or loss. So you can see that the revenue grant, which is 15,000, has been shared like this. 3,000 has been sent to what?
P&L.
Who is that? Who is that? Please, if you're not talking, just mute yourself so that we can move on. So you can see that the grants, which is 15,000, has been amortized over what? 5 years, 3,000 every year. 3,000 every year. So it means that we have sent 6,000 to the statement of profit or loss as income, isn't it? But since the grant has been repaid, it means that this will not be treated as income at all. So we go and cancel it with the 6,000, which is the over depreciation if we are not taking the grant at all, the additional depreciation 3,000. Okay. If the grant is not taken at all, what should have been the carrying value as at the day that we are paying the grant? And what is the carrying value if you are not paying the grant? So the difference, you add it back, and the difference, which is between the grants, will be sent to statement of profit or loss. It means that we have sent a grant income of 3,000 to the statement of profit or loss for 2 years. We have to go and cancel it. And that is also representing the difference between the two depreciations. Another way of doing this is you take your grants, 15,000. This grant will last for how many years? 5 years, isn't it? All right. We have already done 2 years already. It means that we have amortized the grant over 2 years. We have sent 6,000 to statement of profit or loss as income. So we have to go and reverse it. The remaining portion of the grant is 9,000, which is for the remaining 3 years, isn't it? This was subtracted from the cost of the asset. It was 15,000 that was subtracted, but 6,000 has gone to statement of profit or loss. So we go and reverse this in profit or loss. The 15,000 that we subtracted, 9,000 is still in the carrying value, which is a subtraction. So we have subtracted 15,000, 6,000 has been sent to statement of profit or loss, 9,000 is there. So what are we going to do? Since we are repaying the grant, we go and add the 9,000 back. We should have gone and add 15,000 back because we subtracted the 15,000 from the cost of the asset. But since now we are not paying or we are not taking the grant at all, it means that we have to go and add it back. But we have done depreciation, we have accounted for this for some number of years before this. So the question is, what portion of the grant is still in the carrying value? What portion of the grant is still in the carrying value, or what portion of the grant was subtracted from the carrying value? It is 9,000, which is the remaining portion of the grant for 3 years. The 6,000 has already been depreciated and sent to profit or loss as income. You go and reverse it as expense. So basically, this is what we do about the grant. Assume that the grant, the portion of the grant that you are paying was not taken at all. If it was not taken at all, how are you going to account for it at the day that you purchase the asset? You go by the normal process. Compare with if the grant is taken, what is the issue? If the grant is not taken, what should have been the carrying value? Then you look at it and the carrying value when the grant is taken. You add the difference between the two. You look at that if the grant was not taken, the depreciation should have been 20,000. But if the grant is taken is 17,000, it means that every year you're undercharging your depreciation by 3,000. Since the grant is no longer taken, those undercharged depreciation that we have done for those number of years, put them together and send them to profit or loss as an expense. Let's look at this example so that we know what we are talking about.
So Linus,
yeah.
So if I get you right,
you'll be debiting.
Okay, so let me. So you want to use W?
No, just continue. Maybe we are talking about the same thing.
So you're going to debit the asset by now 3,000, credit cash 3,000. That what you are doing?
Okay, what will happen is that the assets at the day that we are repaying the grants, the assets should increase by what? 9,000, because that is the remaining portion of the grants. So that should be added to the asset. So we debit the asset. We debit the asset by. Let me just do that double. We debit the asset by the unutilized portion of the grant, which is this one. Then we credit what? Cash.
Okay.
Are you okay? We credit because we are paying the grants. And if the grant is repayable, then we debit liability because we are here to pay. So that would be an obligation. But if we actually pay the grants, then we debit cash by 9,000. But what is the total amount of the grant that we are paying?
15,000.
So what will happen? We debit profit or loss to cancel the portion of the grant that was recognized as income. So we debit profit or loss with 6,000. Then you still credit the cash.
Oh, okay.
With what? 6,000.
6,000.
Are we okay now?
Okay.
Joyce, are you okay?
Yes, I'm okay. Thank you.
You people, you like the double entry power. Let's look at this. It is all. I just wish we should have more time to do most of the standards, but generally the time no day. All right, let's move on. Auntie Eva.
Linus,
Yes.
is which question?
Illustration under the repayment of grant. You see, I mean, you know how we do reversal of impairment, isn't it? We assume that impairment was not done at all. It's the same thing for the repayment of the grants. The portion of the grant that you are paying, it means that that portion of the grants has not been taken at all. If that has not been taken at all, then what should have been the treatment for the assets at the beginning of the year or from the time that you purchase the asset? If that portion of the grant was not taken, what should have been the treatment from that date? Then you do it. Let's take this example, and I'm sure that this will give us a deeper understanding of that. Then we move on. We take another question. Then that is the end. Let's move on.
May Limited. Is it the May Limited?
Exactly.
Okay, so May Limited purchased some plants in June 2016, costing 1.6 million Ghana cedis. Its useful life is expected to be 10 years, and the residual value at the end of its useful life will be 100 cedis or 100 Ghana cedis. It received a grant of 30% of the cost of the assets in August 2016, having received government approval before it purchased the plant. Any grant received becomes repayable if the asset is sold within 5 years. Its company policies are to depreciate in full in the year of purchase and none in the year of sale. It is the policy of May Limited to use the deferred method of accounting for government grants. Required: A, prepared relevant extracts for the financial statement for the year ended 31st December 2016. B, on July 1st, 2020, May Limited had to dispose of the plant at a value of 900,000 Ghana cedis. Oh, I want to read it. Linus.
Yes.
The
No,
question.
the A is the first part. The B is also another part.
Okay, so then I'm done. The A is required. Prepare relevant extracts for the financial statement for the year ended 31st December 2016.
Okay. And the B is additional information to the first one.
Okay, so B, on July 1st, 2020, May Limited had to dispose of the plant at a value of 900,000 Ghana cedis. Required: prepare the relevant extracts for the financial statement for the year ended 31st December 2020.
Okay. So they are saying, what is the condition attached to the grants?
And is sold within 5 years.
When it's sold within what?
5 years.
5 years. So if you are able to sell the asset within 5 years, you pay the grant in full. All right. So what is the grant given? The grant is 30% of this, isn't it? 30% of the cost. So 30% of 1.6 million is how much?
480,000.
480,000. Okay. When was the asset purchased? It's 2016, isn't it?
Yeah.
And they say it is a policy of this one to depreciate the asset in full in the year of purchase and now in the year of sale. It is a policy of May Limited to use the deferred method of accounting for grants. So what will happen is that we are going to take the cost and we're also going to take a grant as a separate item and amortize them over the useful life of what? The assets. What is the useful life of the assets?
10 years with a residual value of 100,000.
Okay. Residual value is how much?
100,000.
100,000.
Okay. Residual value is 100,000. Okay. All right. So 2016, what will happen? We have depreciation, isn't it?
Yes.
Okay. So what we do is that the grants, maybe we assume that they have done a double entry already. You debit assets, credit cash. The grants, you debit cash and credit what? Grant income. Okay, but we assume that they have done a double entry already. So this will give us 160 million, 1.6 million minus 100,000, isn't it?
Yes.
Divided by 10 years.
10.
How much are we getting for the depreciation for this year? It is full. Don't go and be using
150,000.
150,000.
150,000. Okay. They say it is the policy of them to use full year depreciation. So whether
if you made year acquisition or not, it should be full.
It should be full. Whether it is bought on 31st December, still full. All right.
Okay.
Since they are using full, then they will use the same method for the grant too. Although the grant was received in August, but since they are using the policy of the companies to depreciate the assets in full, we also amortize the grant in full for the first year. Are we okay? So the grant will be 480,000 divided by 10 years. How much are we getting?
48,000.
48,000. Okay. So in the statement of profit or loss, we are going to have depreciation of how much?
150,000.
150,000. And we have
Grant income.
grant income.
Are you writing profit or loss of financial position?
I'm mentioning profit or loss, so you have to know that it's profit or loss. So grant income is how much?
48,000.
48,000. This is an income, so we subtract. Okay. So this is the relevant extract for the year. Okay, let's come to statement of financial position. That will be there. So if it comes to statement of financial position, we have non-current assets and plants. The plants, what will be the amount for the plants? It will be the total cost minus accumulated depreciation, isn't it?
Okay.
So we have the 1.6 million minus 150,000. How much are we getting?
1,450,000. 450,000.
150,000. Okay. If you count to non-current liability, the reason why we are keeping the non-current, the deferred income as non-current liability or deferred grants, you can say deferred grant or deferred income. Deferred income will be better because it's an income which we are taking to the year that we are going to recognize it. What will be the deferred grants?
And
It is what?
432,000.
432,000. Okay. Okay. So this is for 2017. All right. The next year, what will happen? The depreciation will still be the same for 2017. Am I correct?
Okay.
So let's come to 2017. 2017, we are still going to be having depreciation of 150,000, and we have grants income. Grants income for 48,000. 2018, we are still going to have the same thing. Depreciation of 150. Then we have grants income of Grant income of 48,000. 2019, we are going to have the same thing, isn't it?
Yeah.
2019 to be the same thing. We have depreciation of 150. Yeah, grant income of 48,000. But what happens in 20?
No depreciation charge in the year.
What happens in 2020? We sold the assets on July 2020, isn't it?
Yes.
They say the asset is sold within 5 years, but so let's now calculate whether we sold the asset after 5 years or within the 5 years. June to July 2017 is 1 year. Is that it?
Yes. Yes.
Okay. 2017 to 2018 is another year.
2 years.
2018 to 2019 is what?
3 years.
2019 to 2020 is what?
4 years.
So it means that the assets have been sold within what?
4 years.
4 years, which is within 5 years. So we are going to pay the grant back, isn't it?
Okay.
Okay. So right now, let's look at this one now. Let's look at our. How many years did we depreciate the assets now?
3.
No, how many years did we depreciate the asset? Is it 4 years or 3?
Yeah.
2016 is 1 year. 2017 is yeah. 2017, 2018, and 2019. That is 4 years, isn't it?
Okay.
Okay.
Yeah.
So what will be our carrying value now? At the beginning of 2020. 2020 at the start. What will be the carrying value of the assets?
Brian, please mute yourself.
We have depreciated the asset for 4 years and it's 150 every year.
1 million. 1 million. 1 million.
It is what?
1 million.
Okay. It is 1 million. Okay. What would be the deferred income relating to the grants?
288,000.
No, we also amortize it for
4 years.
for 4 years. So
288,000.
280,000, isn't it? Isn't it?
Yes. Yeah.
All right. Okay. So they say since we have sold the asset on
288.
288. Okay, sorry. Okay. But we sold the asset within 5 years. So we are going to pay the grant, isn't it?
Yes.
Okay. But how much of the grant are we going to pay?
The full amount.
480,000.
480,000, isn't it? All right. But if the grant was not taken, what should have been the carrying value of the asset? It will still be the same as the 1 million. Because we didn't subtract the grant from the cost of the assets. The only case that the carrying value will be different from if the grant was not taken is where you are using the netting off method. But if you're using the deferred income method, the carrying value of the asset will still be the same if the grant was not taken. Are we okay? All right. How much of the grant are we supposed to pay now? The total amount of the grant that we are paying is 480. What's the balance on the grant account?
288.
So what we do right now is we debit the grants. The grant is a deferred income, which is a liability. So we debit the grants, 288,000. But how much of the grant are we paying?
480.
So what is the difference?
480.
92.
192, isn't it?
Yes.
Okay. It means that you see those grant income that we have sent to statement of profit or loss should not have been sent there at all, because if the grant is not taken, if you are repaying the grant, it means that the grant was not taken at all. So it means that those 48,000 that we have sent there for 4 years, which is 48 times 4, should not have gone there at all. So what are we going to do? We need to go and reverse them. Reversing them doesn't mean that you should go and reverse them back. This is an estimate. So the difference, which is 192,000, will be sent to statement of profit or loss to cancel the previous recognized grants. Then you now credit your cash if you have actually paid the grants. But if you haven't paid the grants, then you credit grants payable accounts. So this is it. We credit cash. Are we okay now? Okay. This is relating to the grant payment. This is the deferred income, which is very simple. The one that you always see will be the net. So I will solve another question on the net. Then we call it a day. 6:30, we should be finishing. All right. Yes. Is that? I can hear you.
Can you hear me?
Yes, I can hear you now.
I'm not going to continue with the disposal and calculate whether we had a gain or a loss. So
Sorry. So what is the carrying value? What is the carrying value at the date of the disposal? The carrying value is 1 million, isn't it? Because in the year of disposal, we don't depreciate. In the year of disposal, we don't depreciate. So though you sold the asset on July, you won't calculate for depreciation for the 6 months before. So it's the carrying value from the previous year that will still be the carrying value, because in the year of disposal, we don't depreciate. So the carrying value of the assets will be is 1 million, isn't it? But we have sold the asset for what?
900,000.
So are we making a loss or?
Yes, a loss of 100,000.
We are making a loss. So if you go to statement of profit or loss, what you do is that in the statement of profit or loss, we are going to have two items: loss on disposal of what? Plants. Loss on disposal. And that will be what? 100,000. Okay. But what will happen to, we are going to reverse the grant income. So reversal of what? All the grant income over the 4 years, which is 192,000. So this is how we are going to show it in the statement of profit or loss. The asset will not exist because we have sold the asset. So we won't show the plants in the statement of financial position. Let's look at question 1 and I'll solve another question. Okay, question 1, 2. Then we just stop on the government grants. Auntie Eva.
Number 1.
Yes.
Tango Limited. Tango Limited, a manufacturer and supplier of cashew products, has recently established a new facility in Damongo. Is it Damongo? Okay. To help in this new operation, Tango Limited has secured support from the government of Ghana and is unsure how the grants are to be accounted for in the financial statement. The company has a year end of 30th April 2021. And all of the transactions took place on 1st May 2020. 1. A grant of 150,000 was paid to the company to allow it to settle its outstanding accounts payable, and prevent it from going into liquidation. 2. A grant of 50% tax relief, the net effect of which is estimated at 85,000 Ghana cedis per annum, for establishing a manufacturing company in the area. Was to provide employment for the youth. 3. Tango Limited receives a grant of 300,000 towards the acquisition of a machine costing 500,000 Ghana cedis. The machine has a useful life of 5 years required. Explain how each of the above should be accounted for in the financial statement of Tango Limited.
Okay. So let's take the first one. So a grant of what? A grant of,
Please, can you hear me?
yes. All right. So it's okay. The first one is a grant of 150,000 was paid to a company to allow it to settle its outstanding account payable and prevent it from going into what? Liquidation. So how do we treat that?
So we just recognize it as a revenue so
This is
no
to
condition.
this to settle outstanding account payable. This is to settle accounts payable. What do we do?
So we debit our payable account.
We net it against our payables account, isn't it?
Yes, please.
And debit our
Credit,
cash.
then
Are you okay?
debit cash.
So it's relating to payables. So you go and take this amount from the payables, then you debit cash. Anytime that you pay,
I'm confused. How are we debiting cash?
is it? We are receiving
How
the
are we
grant.
debiting?
We are receiving
The
the
payable,
okay. Okay.
the payable is a credit account. So are we not
Okay.
debiting to cancel the debt?
I'm the one saying the other way. The first one is debit cash and credit grants, isn't it?
Oh, okay.
Okay. Then if you actually pay, then you now debit your payables and credit what? The cash.
The grants account, yeah.
Okay. So what will happen is that since this is so we have done the first entry already. We have done the first entry already, which is debit cash and credit what? Grants. We have done the first entry already. Debit cash and credit what? Grants. But this amount was, let me do that one by one. Debit cash, credit what? Credit grants. Okay. So if we pay the payables, what will happen?
Debit payables.
Debit payables.
And you credit cash.
And we credit what?
Cash.
Cash. Okay.
Say cash.
Sorry. Okay. 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 So the grants will now be this one. So at the end of the year, we send a grant to profit or loss as income. Okay. So at the end of the day, we still recognize the grants. We still recognize the grants as an income. All right. All right. That is nice. Let's come to the second one.
Now I just disclose it because you are not getting any actual cash.
So you can see that they are not giving you any money, isn't it? Yeah. Although they have estimated that 85,000 per annum, but is the government giving you the 85,000 cash? No, there is a form of an assistance. So you disclose it. Tango receives a grant of 300,000 towards the acquisition of machine costing 500,000. The machine has a useful life of 5 years. How are you going to account for this?
So I'll use the netting off method. So less the grants and then calculate my depreciation.
Okay. Okay. This one you have to tell the people because they don't know. Explain how the above. So you tell them that this is a capital grant and this can be accounted for using two methods. The netting off method and what? The deferred income method. The netting off method is that the grant will be subtracted from the cost of the machine and the remaining portion will be depreciated over 5 years. The other one is the grant will be kept as grant income and the cost also. So we amortize the grant over the useful life of the asset, and also we depreciate the asset over the cost of the asset over its useful life. All right. And you come with some figures. If you are using netting off method, this is the depreciation that will be charged. If you are using the deferred income, this is the amount that will be shown as grant income in the statement of profit or loss, and this is the amount that will be shown as depreciation. All right. FR people, this is how your question will come. Sometimes they will give you the grant for a number of years. Maybe this one they can say the 150 was given to employ people for 5 years. So you amortize it over 5 years. Every year you take 3,000, 30,000 there. Let's look at this particular question, then we stop. Question 2. Auntie Eva.
Yes, please, I'm on it. Question 2.
Okay.
Dodua Limited is a large textile manufacturing company. Wherever possible, it structures its operations to take advantage of any financial assistance available from national and regional authorities. During the year, a heavy-duty equipment was purchased for Dodua Limited. For Dodua Limited's main manufacturing operation for 12 million Ghana cedis on 1st April 2015. The equipment was expected to be used for 10 years with a zero residual value. Dodua Limited pre-applied for a government grant on 1st January 2015, meeting all necessary criteria for awarding of the grant. On 1st February 2015, the grant was awarded for 40% of the equipment's cost, and the cash received on 1st July 2015. Conditions relating to maintaining employment are attached to the grant, and if they are not satisfied, then the grant becomes repayable or partly repayable. Dodua Limited is expected to meet the conditions when the grant was accepted in a repayment of 10% of the original grant becoming due. The repayment was made on 1st February 2015. Dodua Limited accounts for the grant as a reduction in the carrying amount of the asset required. Explain with suitable calculations the financial reporting treatment of the above in the financial statement of Dodua Limited for the year ended 31st December 2016, in accordance with IAS 20, Accounting for Government Grants and Disclosure of Government Assistance.
Okay. When was the asset purchased?
1st April 2015.
Okay. 1st April 2015. Okay. And what is the grant? What is the percentage of the grant given in relation to the particular? Okay. So that will be 24 million. All right. So the grant will be how much? 40% of that amount is what?
4.8.
4.8. Okay. But they say the company uses what? The company account for grant as a reduction in what?
Carrying amount.
What is the meaning of that?
The net income. Net. Okay.
Is a net. Okay.
Okay.
So what is the difference? What is the, if you are doing net, it means that we subtract the grant from 12 million. Although the grant was, the asset was purchased before the grant was received. But they say that Dodua expected to meet the conditions when the grant was applied for. So since they are expecting to meet the conditions when the grant was applied for, it means that they have started accounting for the grant at the day that they purchased the assets. All right. So what is the difference?
7.2.
7.2 million.
7.2. Okay. So when the grant becomes repayable, it is 31st December 2016, isn't it? All right. So we will be done with 2015. So let's come to how are they going to account for the grants in 2015? We now have depreciation. We are going to have depreciation of what? What will be the depreciation?
So are you going to take into consideration the months?
Yes.
Because they didn't really say anything.
You take into consideration the months. If they didn't say anything, then it will be on pro rata basis. So it will be 7.2 divided by 10 years. Am I correct? Times what? 0.9
over 12.
Okay, 9 over 12. Okay. What will be the depreciation for the first year?
So how are you getting 10 years?
0.54.
You said how am I getting what?
It's okay. You're using 9 years.
No, we are using 10 years.
Hey, sorry, 9 months.
Yes.
9 months.
Yes.
Yeah.
Let's count to 2016. 2016, we will still depreciate the asset before we pay, isn't it? Because the grant becomes repayable on 31st December, which is the last date. Okay. So we come to depreciation for 2016. What will be the depreciation for 2016? That will be full year.
0.72.
Divided by 10. That will be full year, right?
Yes.
Okay. So the depreciation will be what?
0.72.
0.72. So at the date of this one, what will be the carrying value? What will be the carrying value of the asset? It will be 7.2.
6.48.
6.48. Okay. But they say the grant becomes repayable. What portion of the grant are they paying?
10%.
They say 10% of the original grant become what? Due on 31 December 2016, resulted in a repayment of 10% of the original grant. How much was the original grant?
So this should be 1.2.
The original grant was 4.8.
4.8.
1.2.
If you are paying 10% of it, what would be the
480,000.
0.48.
Okay, so let's look at the grants that will become repayable. Repayable grants is 0.1
48.
times 4.8, and that will give us 0.48. Am I correct?
Yes.
Okay. What is the meaning? It means that the 0.48 was not taken as a grant, isn't it? The 0.48 was not taken as a grant at all. The 0.48 was not taken as a grant at all. If that was not done, we are going to use two methods of doing this. 0.48 out of this grant was not taken at all. If that should be the case, then what should have been the actual grant taken? If 0.48 out of the 4.8 was not taken at all, it means that only 90% of the grant was taken. Because we are paying 10% back, it means that only 90% of the actual grant was taken. And that will give us how much?
4.32.
4.32. And if we subtract, what should have been the actual net amount?
$7.68.
7.68. Okay. If this is the actual amount now, then what should have been the depreciation in the first year? This is a long one, but we come to the. Is someone calling me?
Yeah.
Okay.
Please, how did you get the kind amount of 6.48?
It's the 7.2 minus the depreciation for the 2 years, 0.54 and 0.72.
getting 6.48.
What did you get?
I'm getting 5.94.
5.9.
9.
Okay.
That's correct.
5 points. Maybe the person subtracted only the 0.72 from that one. 5.94.
Yeah.
Okay. So
Because
that
I have not followed what you are doing, so I'm even confused.
okay. So if the grant was not taken at all, the net if the 10% of the grant was not taken at all, our net amount should have been 7.68. So if you're using 7.68, what should have been the depreciation every year? 7.68 divided by 10 times the first 9 months, which is 9/12. So 2016, what should have been 2015, what should have been the depreciation? What should have been the depreciation? 7.68 over 10 times 9/12.
0.576.
0.576. Okay. Let's count to 2016. What should have been the depreciation if the 10% was not taken? It should have been 7.68 divided by 10.
0.768.
Okay. The depreciation should have been 0.768. What should have been the carrying value at the end of this period?
$6.336.
6.336. 338. 6 point what?
336.
336. Okay.
Yeah, 336.
Okay. Assuming that 10% of the grant was not taken, this should have been the carrying value, isn't it? But what is the carrying value when we assume that this thing was taken, the grant or the grant was taken? It was 5.94. Let's find the difference now.
$0.396.
0.396. Okay. What is the depreciation over here? What is the depreciation? Assuming that all the grants were taken, it was 0.54.
54.
But if the 10% was not taken, it should have been 0.576. What is the difference in the depreciation?
$0.036.
0.036. Okay. If we assume that all the grants were taken, the depreciation for 2016 was 0.72. But if the 10% was not taken at all, because we are paying back, so it means that we haven't taken the 10%. What should have been the depreciation? 0.768. Let's find the difference. What is the difference?
0.048.
0.048. For all of this, what should have been the correct treatment, assuming the 10% was not taken? If we know that we are going to pay the 10% back, we should have used 7.68 for our entries, isn't it?
Yes, sir.
Since we are paying the 10%, the actual depreciation for the first year should have been 0.576, but we charge 0.5. So what are we going to do? We need to go and add the difference because we are undercharging. If you count to 2016 to we are undercharging. So the total depreciation for the total undercharge depreciation would have been 0.036 plus this. If we haven't taken the grants at all, the 10% of the grants at all, our carrying value at the date or at the end of 2016 should have been 6.336. But we assume that the 10% was taken together with the grants and we are having 5.94. What do we do? We now go and add the 0.396 to the 5.94 to have the actual carrying value. Another way of doing this is this. What is the grant that becomes repayable? It is 0.48 million. Okay. This grant will also be amortized over 10 years, isn't it? This portion of the grant will also be amortized over 10 years, isn't it? All right. The 2015, we have used 5 months of this grant because we amortize, we charge the depreciation of what? 9 months. It means that if we should have carried the grant as a deferred grant, we should have amortized it for 9 months. So we count to the amortization for 9 months based on this grant. Amortization will be 0.48 divided by 10 times what? 9/12. So in the 2015, we used 9 months of these grants. What will be the amortization figure?
$0.036.
0.03 what?
6.
6. Okay. Let's count to 2016. Amortization will be what?
0.048
divided by 10. Amortization will be 0.048. So what will be the carrying value of this particular grant now? What will be the deferred income, the balance on this particular grant?
Hello, sir. It was 0.48. If it's 4.8 divided by 10.
0. What?
48.
No, so change this one.
Okay, to be 0.048. Okay.
So that would have given us
0.48. So what will be? It means that we have used 0.036 and 0.048 of this particular grant for the 2 years. What will be the remaining figure on this one? What will be their balance? What will be the balance left on this?
0.408.
0.408. It will be 0.48 minus 0.036 minus 0.048.
Yes.
So what are you getting?
0.396.
0.396, yes.
0.396. Okay. Another way of solving this question, the first one that we did, you assume that that portion of the grant was not taken. Then you will start everything from the beginning. If that portion was not taken, how the accounting treatment should have been done. Then you do it. If you do it, you see that the first depreciation was undercharged by what? 0.036. So you have to come and add it you have to go and reverse, you have to go and do the right thing because the depreciation should have been 0.576 if that 10% was not taken. But you are charging 0.54, you are undercharging. So this is now an expense. If you come to the second year too, you see that this is an expense. If you come to the carrying value, you see that there's a difference of 0.396. Go and add it to the carrying value that you have, assuming that the grant was taken. Let's come to the second side. The second side, you assume that the grant that you are paying was also amortized like the way you depreciate the asset. So the first one, because we have subtracted this amount also from the asset, it has reduced the depreciation. So we ask ourselves, by how much was our depreciation charge or by how much was our depreciation overstated relating to this grant. Then we calculate the amortization for 9 months. You can see that this is the same as the first difference between the depreciation, isn't it? If you come to the second one, you can also see that this is the second difference between the depreciation. And you can also see that this is the difference between the carrying value. So you can also amortize the grant that you are paying, like the way you charge your depreciation, because this grant was also subtracted from the asset before we charge the depreciation. So it means that this was also amortized. So let's amortize it back and go and add it because it has reduced our depreciation. So you do this, this is the excess depreciation, and this is also the depreciation for this year. You add the two. Then you now come, if they have amortized these two, what is the remaining balance on the assets now? This is the balance that is included. This is the balance of the grants relating to 0.48, which was subtracted from the carrying value. Go and add it back. If you can't do this, just assume that that portion of the grant was not taken. Then you do the original one and you compare with the one that you have done if the grant is taken. At the end of the day, you get the same figures. 0.4, 0.036 as the difference, 0.048 as the difference, and 0.396 as the difference between the carrying value. So in the statement of profit or loss, the undercharge depreciation for the 2 years, which is 0.036 plus 0.0448, you add it and add it to the current year's depreciation. You add it to the current year depreciation. Then you come here, you increase your carrying value, which is the 5.954, assuming that all the grants has been taken. You increase it by this figure to now have the actual carrying value if the grants, the 10% grant was not taken. So you pick the one that you are comfortable with. All right. It's 6:36 and we will see what we can do. We see what we can do on next week, Saturday. We see what we can do on next week, Saturday. The corporate reporting people, you see, I've sent some videos on standard which are treated with the financial reporting students. I'll be doing some standards with them and I'll be sending the videos to your platform. You watch. If you have any problem, just contact me. So we do the intangibles together with maybe earnings per share. Okay, let's do earnings per share next week. That is all. I don't have the feeling that the leases will come. But if whatever will happen, by next week, we end the class. But during the week, during that particular week, I will try to fix a class so that we finish some of the things that we didn't do. All right. You just have to cooperate or anyhow, so that we can finish things. You know that I'm not going to write the exam, so maybe I don't have any problem. You are the people that are right. So if you want to go there, you see the question, you ask yourself, where is this question coming from? Then you can decide not to cooperate. All right. So let's see whether we can do additional 4 standards before we go and write the exam. Earnings per share, intangibles, leases, and maybe, I don't know. Maybe I can do the intangibles for financial reporting student next week Saturday, and I'll upload the video so that we do leases and earnings per share on Saturday. Let's see what will happen. If whatever happens, I will fix a class for within the week, maybe 18th to 22nd. Maybe after the intervention, where I can still do some classes. So don't worry. All right. Yeah.
Yeah, good evening.
Yeah.
Yeah, I joined late, so I don't know exactly what you are doing, but I've seen that you are amortizing the grants.
Yeah.
Does it mean that we consider the grant as an intangible asset?
No. Amortization of the grant means that if the grant will be for a number of years, it means that you take it as at when the year goes by or something. So if it is for 5 years and you are reporting, if you are taking 5,000 and say this amount will be for 5 years, it means that every year, how much will you be using? If if it is 5,000, they say you are going to use the 5,000 for 5 years. It means that every year, how much will you be using?
That is 1,000 Ghana cedis. That is 1,000 Ghana cedis.
Okay, you'll be using 1,000. That is what we are saying, the amortization. It doesn't mean that it's intangible assets.
Okay.
Okay. If you are taking a part of money or revenue that relates to a number of years, and you are trying to take it to the years one by one, the best word that we use is amortization. We don't use depreciation. We use it and we are amortizing it. So it doesn't mean that it's an intangible asset. Are you okay?
Okay, I get it. Thank you.
All right, you're welcome. So ladies and gentlemen, I will see you. CR people, we will continue tomorrow. All right. Okay. So thank you all for coming. I will see you people.